afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is May 9th, 2024, and today we're going to talk about how retail could get ravaged. Now, when I say how retail could get ravaged, what I'm really getting at is how consumer spending could be altered, or how consumers are not getting any benefit of what is going on in the markets with bonds and with money supply. We'll get to that here in a minute, but I want to focus on two key aspects that were reported today that are feeding into that situation, if you want to call it that. And that is weekly new unemployment claims and the bond auction. We'll start with the bond auction. We'll come back to the weekly unemployment claims. Bond auctions showed that we had equal to higher demand on lower interest rates. So what the Fed does when they offer these bond auctions, they tell us how many bids to cover they had for a specific interest rate. And that is to say, if they offered bonds at a specific interest rate, how many offers they had to buy for every bond that was issued. So today and last time, we got a 2.4 bid to cover. That means they said, here's X number of bonds, and they had 2.4 times the number of offers at that rate. And so when you see either a higher bid to cover or a lower interest rate, that is an indication of demand. And that's what we saw today. We saw that yesterday prices sold off, continued lower on the open this morning, recovered, and have recovered basically all of Wednesday's sell-off, not closing higher, but definitely closing or trading up to the open of yesterday. So we've erased, in essence, that selling pressure that we had from yesterday. But reality is, this is because we offered a 4.64% rate, lower than last time's 4.67 rate, so 0.03% lower, 3 basis points, very nominal, I know, but still a lower yield for equal demand. They didn't have to raise rates to get the demand from the market. They were actually able to cut rates that they offered on their bonds, a new bond issuance, which means money costs the government less, and it's going to cost less to borrow. And that's what drove this move here. And we saw it in the yields. The yields actually fell that same equal amount today. Now, as we saw bond prices recovery, and we could go look at TYX. TYX is the 30-year bond treasury yield, and you'll see that sell-off gapping up because it is not a future, it is a regular traded hour index, and so it gaps up and closes down. And that's the erase of the rate hike and back down to Tuesday's close. So basically the reverse or inverse, only showing the regular trading hours in the 30-year treasury yield. Now, that 0.03% drop is not that big of a deal, but it is an indication that demand remains high for bonds, even if it is at lower interest rates. So that's kind of a mixed bag. Does that mean we are running for safety, or does that mean we're excited about the yield dropping or slightly fading? And then the question is, even if yields are dropping, even if the cost to borrow is sliding, who's benefiting from that? It's certainly not the consumers. Today, consumers saw a better interest rate, but they also saw the unemployment rate reach the highest level that it's been in weekly new unemployment claims. And that means new people, not the total number of people unemployed, but new people filing for unemployment. That reached 231,000 people filing for unemployment. That's an 11-month high. It's actually equal to the November 2023 high. And then we're going all the way back, and to get to the previous higher number, we have to go to August of 2023. And so that's kind of what we're looking at right through there. Now, that's a lot of reports because this is the weekly new unemployment claim filing. So highest level in 11 months, and you could extrapolate that and say that's the highest level in, say, 47, 48 weeks. That's a big deal. And so unemployment and new people filing for unemployment, new people being laid off is on the rise. We already know there's 7+ million unemployment or 7+ million layoffs announced that are going to continue to feed into that weekly new unemployment claims filings. So we're pushing higher. Consumers do not have the money. Now, I don't know if you've seen the report, but there's additional things that are going on, such as with PayPal. PayPal and others have been offering a buy now, pay later kind of scenario. Buy now, pay later is a situation where it's kind of like layaway, but you get to take it with you. You get to say, hey, I want to buy this couch or this TV or this car even, and I will make payments to you later, or I'll have 12 months of interest-free payments. And it drives demand in the short term, but the problem is those loans are not being reported to the consumer or the credit bureaus. And so all the defaults we're seeing in credit cards are not showing in here. And who are the people that are going to do the buy now, pay later? Well, the consumers that are strapped for cash. Still want stuff, still want to buy stuff, but they've been buying that, and we know that's going to feed into defaults with the buy now, pay later crowd, as well as what we're seeing in credit card defaults. And we're going to get the credit card default report, the quarterly report, here in about 2 weeks. And I'll come back and revisit that again, but it looks like that's going to be at already at 11-year highs, and we could see 13-year highs on credit card defaults. But those are going to play out into something like PayPal and CarMax and some other stocks. I'll talk about that more tomorrow. But we're likely to see that feed into here. We're already seeing a gap up on earnings and fade, and we're likely to see that continue to fade as those defaults start kicking in. And so these companies have been leveraging out and paying to consumers when consumers, one, don't have any money, two, are already strapped for cash, three, are living paycheck to paycheck, and so even their needs are now starting to wane, are going to see more and more defaults in all these credit cards from the consumers. So the money is moving towards things like industrials. Now, if I look at XLI versus XLY, XLI is pushing up to retest the previous high, setting up for what I consider a potential significant breakout. XLI could go from 120 to 126, which means we could be looking at a 6-point break through the high. We could be headed to 132 and possibly higher on XLI. XLY, consumer discretionary, however, is not pushing to the new highs. In fact, is pushing to kind of this mid-range resistance. And I'm going to be looking to fade XLY, but even more so, I'm looking to fade retail. And so if we look at the retail sector is pushing up today off of that news of lower cost to borrow. But the fact is we have a support here, a resistance here, a gap here that's never been breached. It's filled the gap, but it has not closed above there. And I like the idea of shorting retail up XRT near where it's at today. Now, we could get into some specifics like JWN, where the little rally is already showing weakness, and I would be looking to sell call verticals against Nordstrom near 2021, or simply buying a put, because I think there's a very good chance that we hit 17 over the next month. Other things to consider in this consumer discretionary area would be things like travel, like booking, Airbnb, which is already struggling, and I also like that one as a short. Automotive, we already know that we're leveraged up. Tesla's already down 1.64. GM is flat for the day, or up a fraction, and Ford is down a fraction. So I'd be looking to sell automotive. I'd be looking to sell things like we already said with Nordstrom, maybe even TJ Maxx and Ross. Anything in the leisure sector, including Marriott, Las Vegas Sands, as we've already talked about before. DRI, Darden Restaurants, that's down while Domino's Pizza's up. That means we're substituting going to eat out for fast food and sitting inside. And so we're seeing that play out in the retail sector, and I do think you're going to continue to see that weaken in the stuff that is more costly and unnecessary. But as we're watching this, we know that with the bond auction, we are putting more money supply into the markets, and we know it's at a lower interest rate. So who's getting that money? It's primarily government contractors. And so as I look at industrials, this is where I'm looking for continuation of bullishness and continuation of strength. So I'm still leaning into the defense sector. We've already talked about Raytheon. We've already talked about L3 over here. We've talked about simply taking DFEN, D-F-E-N, as a trade based off defense contractors as an ETF. But things like Caterpillar could be a good one to continue to trade. Deere, and trading in the direction of that. And I would also focus on electrical equipment. We have a lot of work to rebuild the infrastructure, or build the infrastructure bigger to be able to handle AI. ETN had an amazing day today. I don't know if I'd buy it today, but I'd be certainly looking to buy on any type of a pullback. And if we can clear 408 and clear 429, there's a lot more upside. But the one that is kind of positioned where I think we get a signal in the next day or two is ETN. So if we take a look at Eaton, today is potentially the highest close and potentially even the 52-week high. This price pattern through here would tell you that you could see a move from about 303 up to 333. And so we're looking at a 10% breakout on Eaton by clearing the highs. Just to revisit the defense contractors, you can see that we already broke through that high. That was what we were looking for. The upside target for DFEN is going from about 23 here to about 27, 26, 27. So we're looking for this to reach 30, 31. We're about halfway there, but there's still another $2 or $3 move, which means we've already moved up more than 10% since we put this in our long-term portfolio, and we've got another 10% to go in DFEN before I'd be looking for taking profits. So it looks pretty promising for the industrials, pretty bearish for consumer discretionary and retail, and that's kind of where we're at. The money that's going into the market is not going into the consumers, it's going into the industrial area and primarily to those things that will get government contracts. And so we will continue to see money move into fund those projects that have already been approved or already had budget placed for those as this money continues to flow into the market from bond auctions and from the Federal Reserve. And it could be as easy as betting on that concept going forward and saying, I want to buy XLI. It hasn't broke through the high yet, but it could over the next day or two. And I want to short XLY. XLY is worth 179, XLI is worth 125, and so we could do about a 3-to-2 ratio here, 3 times XLI minus 2 times XLY, and be looking to buy this. And if we're going to buy that on the breakout, these moves, which may not seem very dramatic, these moves in these sideways from $6 to $28, or even waiting for it to break through $28, it could repeat that same size move, which is $23, and that's nearly 100% return on risk from the current level. So there's a lot more opportunity in buying industrials and selling consumer discretionary, even in a pairs trade like this. So that's what I'm watching for, and I'll be watching for that over the next weeks, months, and even years, because I don't see this remedying really quickly, especially if consumers are strapped for cash, especially if we're seeing more and more unemployment claims, and especially as we see money supply getting into the market but not to the consumers. That's going to do it for me today. Thanks for watching, and join me again next week.